Welcome back to Trading Hour. Let's get a conversation going on where the markets could really be headed from here on. We have Jyotivardhan Jaipuria joining us, founder and MD of Valentis Advisors. Jyoti, always great to have you on this show. You know, my first question is that we saw this big momentum, right, built towards the last week of November. Now, do you think that we're just going to sit at these kinds of levels for a while, consolidate, or do you think that, you know, the momentum could pick up very soon?
No, I think, Pavithra, now that we've seen this quick rally, which has happened partly because of, the elections, we probably enter a phase of consolidation. There's obviously quite a bit of good news on the economy and on earnings, but valuations are not cheap. And I think it will be good for the market longer term if we get a phase of consolidation where markets absorb these gains. We may get a bit of price correction also. And that will be good. As we know, like if you look at the last 9 elections, in 8 of them, we've had a pre-election rally, and the average return 6 months before elections to the day of elections is like 14%. So you've seen that because, the assembly elections were a positive surprise for the market. And I think, after that, we need to absorb the gains a bit. We'll be getting into January, probably that's where markets generally tend to, come down a bit.
Jyoti, at the beginning of 2023, the markets were calling for a dovish tilt from the Fed in the middle of 2023. That's what the prognosis for the market was. But instead, the Fed continued to remain higher for longer, very tight liquidity conditions. Now, again, as we begin 2024, the call is for aggressive rate cuts next year, starting May, June. What's the probability or what's the risk that this doesn't play out the way the market is expecting? And what could be the impact if it doesn't?
Yeah, so Reema, there are 2 things to it. One is if it plays out the way market wants, that we have aggressive rate cuts, but that comes about because we have a recession in the US. So if you go back to the beginning of this year, everybody called for a recession in US this year, and the whole prognosis was there'll be a recession, and that's why Fed will be forced to cut rates very quickly. We never got a recession. The economy was good, and Fed never cut rates, but the markets were fairly decent. Next year, we may get a rate cut cycle, which is, sharp, but then if that is accompanied by a recession in the US, it may or may not be good news then for the markets ultimately. So I always say we should be careful what we are wishing for. The other scenario is the economy continues to be fairly okay. We don't get a recession, but because inflation is under control, we have rate cuts. So my guess is the second scenario is what will play out. But the rate cuts will be probably later than what the market today is building in. And we obviously have the Fed meeting today itself, so we'll know what they say. But my guess is they'll say, we are not going to cut rates in a hurry, though we're not going to hike rates. So probably the first half of next year will be a status quo first half, where, we have Fed not really cutting rates, but not really hiking rates and waiting and watching. And probably second half is where we get the rates cuts really coming.
Okay, got that. Jyoti, considering that we've had this rally, you expect that maybe now we will see some consolidation, some correction. Where do you expect this to really come in? Is it some of these sectors, even the smaller sectors, that have run up a lot? Because those are also the managements which are still sounding very positive. Those are the, sectors which typically have longer sort of cycles, right? So where do you expect this cut to come in?
Yes, when the market corrects typically, and this is like across any cycle, most of the stocks which have had recent very sharp moves, they're the ones which fall more actually. That's where a lot of the excitement is. That's where a lot of the earnings growth is coming. But it's just that, valuations have run up in such a short span of time that you start to have a valuation correction there. A lot of it is just a PE de-rating from a very high level. And, that's where the initial round of correction comes in. Most people want to buy that correction because, if we have a correction now, I think the whole thing will be, let me buy that dip because, I'm getting a chance and I want to buy it. So these stocks, when they correct, people will want to buy some of these names.
So these names, I mean, you're including all of the power, defense, railways, real estate, all of that?
Yeah, some of those names which have done very, very well. That's the first inclination always, you buy the dip and buy the stocks which have done well. Recently, and people think that's where the most money will be made.
Just broadly tell us, what's the portfolio construct now? Have you increased your cash holding because you're expecting some consolidation? Tell us a little bit about your portfolio right now and how it's changed in the last 3 months.
So, Reema, we are still largely into buy local, avoid global, which we've been for a long time. And even within local, we still have a lot of the names which are more investment focused rather than, consumption focused. But what we've added to the portfolio recently has been the banks. Because, from like, let's say the whole of this year, the bank sector not really done well. We had a great spell in banks last year, but in last 1 year, banks have been very, very subdued in terms of stock performance. So banks is one sector which just valuation wise is looking good. There has been underperformance in it recently. And so we've been like adding to a lot of the banks, especially the banks which are trading at low price to book. Private sector, smaller banks, some of the public sector. Those are the spaces we've added to. The second thing we've kept adding to is pharma, which, like I've spoken on a couple of earlier times. We kept adding to pharma over the course of this year. And our whole thesis that the US generic prices have bottomed out, that continues to play out. So that has been the other space we've been adding to. We have some cash in the portfolio. So we have between 10 to 15% cash in the portfolio. I'm hoping we get some pullback in Jan-Feb, which helps us to, deploy some of this cash in the market.
And if you do get that dip, which areas will you first look to deploy that cash? Will it still be in pharma and, the banks?
Yeah, it will be probably some of these domestic names which we want to. Now, one space which we are watching, it's come on our screens after a long time, is the software space. But I still think, we probably will have some negative news over there based on the US economy starting to slow down. But if we get like a lot of negative, we're wanting negative news in the IT sector so that we can, deploy some money over there. So bad news in IT is probably what we'll use to really buy there. But otherwise, the first inclination just now is to buy some of the names we own. Probably cement will be the other sector which we'll keep adding to.
Okay, very interesting chat, Jyoti. We hope to have you back on the show soon. And IT is a space where, a lot of the people seem to be having a little bit of a switch of opinion now and hoping to buy, like you said, on dips. Thanks for joining us today. We do need to take a short break now. But on the other side, there are 2 IPOs which have opened for subscription today. We're going to bring you the details as well as a word on, from the management on both of these companies.